Good afternoon, everybody. My name's Len Monzi. Welcome to the Preccelerator. We are live and in person today. And while you're out there in Zoom land, you could be sitting here having lunch with us. So stay tuned. Our workshops in the future, we're going to start moving into a more face-to-face in real life workshop program, but continue with our new technology, our new Zoom technology that has cameras following the speakers around and able to share our presentation. So thank you for being with us today. Today we have one of our Preccelerator mentors to present on smart money, smart finances, and how to prepare for your coming year and ending last year. I think there's some tips that will come out of this session. So Zen Wei, take it away.
Thank you, Len. Thank you, Len. First of all, it's always a pleasure to come out.
I'm going to wait for the delay.
Oh, here we go.
Let it move over to you.
I think they saw me, actually. Well, it was a great pleasure speaking always at the Preccelerator. And yeah, so it is about the end of the year that we need to prepare for our taxes and the finances. But I think for today's call's purposes, it's more, we also help companies, especially VC or potentially VC funded companies, to understand how you can do projections and how you can understand what you need essentially to operate your company at the early stage. So a really quick introduction about myself. I previously worked in the corporate environment, being EY or Goldman Sachs for over 12 years combined. And in 2018, I actually started on my own to start my own technology credit. And this is a SaaS-based software company to help, especially VC, what we call small businesses, to claim R&D tax credits, giving the cash back to the small businesses for running the operations. At the same time, probably in 2019, I also co-founded a consumer fintech business. It's called Cheese. It is a challenger bank where you actually get a debit card, your wallet, you can kind of use it, and we offer a lot of the cashbacks and rewards, and also we give back to the community based on the cashback that we get. And also we're rolling out a lot of the features, such as credit features for individual finances. So going back to today's kind of agenda, so we want to mainly talk about three things, right? So we know it's the end of the year. I wanted to give everybody a little bit of tips in terms of what you can do to expedite the processes without spending a huge amount of money. Also give you some kind of guidelines in terms of how to get help if you need those type of helps. Also, we'll talk about product market fit. I kind of being a founder myself, you helped over 120 companies for the last 4 years through my SaaS businesses. One of the key challenges for early stage companies is how to find your product market fit and what does it cost and how much it takes in terms of finding the product that is being accepted by the market. And this doesn't have to be any kind of high tech. It could be consumer businesses, it could be B2B businesses, it could be technology in biotech and chemistry and whatnot. In the last section, we want to talk about financial projections, right? So kind of coming out of the year, we're going to the new year. We probably wanted to kind of see where we're at with the finances, if we need to reach out to VC, how we can do a better pitch in front of them to demonstrate our values. And therefore, a lot of the stories can be told in the financial projections in that matters. All right, let's jump right into the what we call the 60 minutes drill. The reason I call it 60 minutes drill, technically for an average person with a little bit of understanding of finances, it shouldn't really take you more than 60 minutes to get all the stuff together and either send it to your CPAs or send it to whoever doing the internal finances, or even doing it yourself. Most likely, especially for an early stage startup where you have not generated much of a revenue, or let's say all you got was VC fundings or venture debts. That's in essence, 1 to 2 hours should be able to take care of it. Now, there's three things. Okay, just wanted to make sure that you guys keep an eye on it. The first thing, of course, is preparing your end of the year financial statements. You will need to take that to your CPAs to file the tax returns. So what do you need, in essence, if you already integrate with the QuickBooks, you kind of pay the subscription fees. Hopefully, you kind of have put all of the expenditures in the right buckets. If not, the CPAs or whoever filing the tax returns is then actually recategorize it, right? But there's also an easy way, what we call the shortcut ways, talking about downloading an Excel version of the bank statements. You got different categories of in and outs, and then just use a pivot table as easy as that. If the transaction amount is not huge in terms of volume or the frequencies, you can actually just do an Excel spreadsheet and categorize that, and then your CPAs or any tax software will be able to take that. Same thing being said for the tax return preps. If a CPA charges, let's say $800, $1,000 or $2,000 to file your taxes, at the early stage, I would say, sure, you get the CPAs to help kind of start with the right footing. But a lot of the time, if you, especially at what we call super early, you just register a company, you might not even have much of the transactions. It's kind of a, to me, it's a little bit waste of time just to have to spend over $1,000 to tax returns. You can technically get a software for $60 and file your own tax returns and answers a couple of questions and be done with either your federal and a state. In this case, will be California. Okay, so those, as far as being able to prepare and being able to file your taxes, especially for early stages, I think you can actually do it on your own, and there's no such thing as a right or wrong in my view. Especially at an early stage, you can always come back and correct it. When you're not paying taxes. And then in the later on stages, when you start have customers, when you start have revenues, when you start have a lot of VC monies that you want to have to convert some of the, let's say, debt to equities, that what we call balance sheet or income statement or financial statement becomes more complicated. Okay, and that's when you probably need a professional help. The other thing I wanted to mention, you can do actually yourself, without having to spend a lot of money, is a lot of the state and local filings, right? So I think most of our VC-backed companies are registered in the state of Delaware, and that's kind of one of the preconditions for a lot of the VCs in order to put money into a company is that you have to register in the state of Delaware. So Delaware has an annual tax that's due, regardless if you had you made money or you lost a lot of money. It doesn't, or you just barely started. It's due by March 1st. So we're kind of a little bit past 7 days past that deadline, but if you miss it a little bit, there's no problem. They typically assess very, very little to none in terms of penalties. Very easy. That annual report takes about, on average, 5 to 10 minutes to finish it. There's only 3 pages in total, maybe over less than 10 questions. Very, very standard questions. Something that you can do on your own in a very short time frame. Also, the second one, and this is something that we always get in trouble with, is the California minimum tax due on an annual basis. And typically, you have to file your tax return by April 15th without an extension, and you have to pay $800 before you at the same time when you file the extensions, right? In California, there's also another thing called a statement of information, and that's you also have to file annually. The statement of information annually costs you $25, and it takes you literally 3 minutes to file it. Okay, it's 2 questions: what you do and who's your company doing business with, and who are the directors, the officers. Within 3 minutes, $25, you take care of it. However, if you miss the statement information, guess what? The California's going to assess you $600 penalties for not filing it. So that's kind of what we call a no-brainer, something that you can do easily and just pay the $25 and get rid of it quickly. Make sure you do that on an annual basis.
Sam, is that something that has to be done annually or biannually?
It's actually annually now.
It is annually now?
Yeah, it is.
Yeah. It used to be every other year, correct?
It's usually every other year.
So this is an even year. It used to be on the odd year. So a lot of people can be surprised.
That's right.
If they don't do it.
If they don't do it, yeah. And the way that they do it is that they look at when you're registered in the state of California. Let's say if you're on a month of January, then you need to do it by the January of next year. So there's not a fixed date, but you just need to make sure you file it. And typically when you go onto the statement of information websites, they will tell you if you need to pay $5 versus $25, and depending on what year, what time frame you're in it. The third item is the what we call the non-typical items. Again, when you come to the end of the year, right? When you look at what you did in the last year, what I'm going to do in the next year from a finance and tax standpoint, there's also some kind of question that typically pops up, not very often, but the state nexus taxes. The state nexus taxes typically apply to businesses who probably have generated a lot of, let's say, sales or revenue. It doesn't matter if you're profitable or not, right? The state nexus tax is meant to what they're really trying to do is, say, for example, a company sell SaaS software, subscription services. It doesn't matter if your customers in California or out of the States. If, let's say, you spent you actually collected $100,000 of sales from all of your customers in the state of Kansas, just use that example. you operate out of California, you develop your software in California, right? And you just kind of put it on the internet and ads, Google search, and people just start using your product. And this $100,000 happened to be coming from state of Kansas customers. Now, if you don't tell Kansas, sure, they typically won't come out and say, hey, you need to pay taxes. But in a tax law, it actually says if you have derived the benefit from the state, and in this case, it would be the state's customer paying you for the services or paying you for the software, then technically you have a filing requirements in that state. Now, typical CPA might not get into some of the weeds and the details of which state you need to do it, and the Nexus study is typically done at a more experienced accounting firms. But I want to leave it out there, just kind of give you some heads up. Okay, if you have a lot of sales coming out of other states, you might actually trigger a potential filing requirements, and you might get dinged by the state government and say, hey, you have been doing businesses in my states for so long, you never pay any taxes. So that's something to be on the lookout for, right? The California, the second one, California sales and use tax on imported goods. Again, doesn't happen very often, but every time you receive a bill from the state of California, it's always crazy, right? I get a lot of letters saying, hey, can you help me with this? And I call the California state, and they basically catch you for typically it's on hardware. So when you import hardware to do, let's say, prototyping, to do testings, you beat them up, you ship it off to outer states, or you throw it into trash. The California state look at it as if you use those equipment or the imported goods in the state of California. However, because you import it from the outer states or out of country, the California initially did not, the custom initially did not charge you sales tax or use tax on those. But they would think that since you used it in the California, then the California wants to impose the sales and use taxes. So in this case, in order to avoid those, right, if you have a way to, they say, hey, I ship it out, show them a picture, show them a shipping bill, and say, hey, I shipped this out to Vegas or ship out to something else. That's typically one way to get rid of it. Or of course, if you sold it to someone else, that's also one way to get rid of it. If you just tell them I throw it away, unfortunately, that's you're owing taxes if you haven't paid in the past. The last item on this 60-minute drill is the 409A and 83B. 409A, I think a lot of you might be familiar with the concept, right? When you create a company, you kind of set up an option pool, or you can issue your founders or yourself what we call initial founder shares. And that's the time when you need to file the 83B. And at that time, you might not need to do a 409A. 409A is a company valuation just based on the book value in terms of how much your company worth. It's very different from the values that you're telling the investors, what's my valuation. That's two separate valuations. 409A just kind of put on the book how much company you're worth, and typically at the inception of the companies, it's about 0.0001 cent a share, and depending on how many shares, may add up to $1,000 in total. Once you give yourself some shares, make sure you file the 83B within 30 days so that you're protected from a tax standpoint. All that means is that when your company starts to do better, your values start to grow, your 409A start to do better, you're increasing the values, you don't have to pay taxes. What we call, those are fictitious gains, right? You never really receive any money. You're just realizing some of the values from running a really profitable business or running a good businesses, just to make sure that you file the 83Bs, if that's the case. All right. So that's what we I think items to notice, items to keep an eye on at the end of the year. I wanted to talk about, spend a bit of time talk about finance or product market fit. Sorry.
So before you go in launch into the second part, is there anything specifically for COVID that needs to be paid attention to? For instance, if anybody received the PPP loan, yes, and or an EIDL loan.
Yeah. So the PPP loan, it has been very, very favorable. And thanks for mentioning that. I think a lot of the company, in order to receive PPP loan, you would have to have, for example, employees, right? You have the EIDL loan. If you had a company in existence, it's either 1,000 or let's say 10,000 at the maximum. So the PPP loan, the good thing about PPP loans is that the government doesn't want to tax on it. It's supposed to be given it to you as a benefit, but at the same time, you can't deduct expenses to say I'm going to lower my profit. So you can't kind of do the double whammy on that. Typically, PPP loan, if you have it on your balance sheet, like I said, you can exclude it out of your income statement, you can essentially take it away. So no income, no deductions, just treat it as if this doesn't happen. That's different if you were to have to pay back. Okay, so there's a lot of the time where I have a couple instances where a company got the PPP loans and they were not 100% forgiven. I think the threshold is if you're under $150,000, the bank, whoever issued the PPP loan, will send you a letter. It's called a self-testimony as far as, did you use all the PPP loans on qualified expenditures in terms of categories, or did you not? If you're over $150,000 in terms of the loan amount, then you're required to provide a lot of the documentation, right? Where you spend on the wages, show me the wage report. If you should spend on rent, show me the rent receipts or bank statements. If you're under $150,000, I think it's much easier to kind of self-attest. If you didn't, then a portion that become payable, you essentially need to record on your balance sheet and on your income statement. Either the interest you accrue or you have a liability on your balance sheet, and those are the amounts that might affect you in the future. But typically, depending on when your loan is due, that is the timing when you have to be careful on when to disclose those type of informations. Okay. All right, finance your product market fit. One of the reasons I wanted to talk about this is, although it's kind of more aligned with on your product team or your technology team, but I found that in order to do better with managing your finances, a lot of the founders actually have started to look into how I can, calculate, how I can estimate what is the time that I need in terms of the cost associated with finding my product market fit. Now, finding product market fit is very, I won't call it easy. It's actually quite difficult depending on what industry you're in. And let's say how many competitors, there's different variables that defines and also help you kind of quantify how fast and how quick you can reach your product market fit. But to develop a good sense in terms of how to finance your product market fit, number one, it will help you stay focused. That's what I think is one of the biggest benefit as far as I have little money or I have a lot of money, how can I spend it, right? How can I prove to either my customers or my investors that I have this product that's going to be viable, I have this product that is going to reach a big, mass populations and demonstrate the potential value that you're trying to demonstrate. At the end of the day, aside from hiring the right people and have a lot of people to work on it, it's also estimating how much money you need to get to the first stage or get to a comfortable stage where investor will be coming to you, competing for your term sheets instead of you going out and talking 100 investors maybe get 0 to 1 term sheets at the end of the day. So the whole concept here is that assuming we're early stage, right? We have an idea, we maybe have tested a little bit of the concept from your family and friends. You're entering into the death valley, that's what we call it. So you're really kind of trying to come out of it in essence that can my product get mass adoption or get mass acceptance based on what I'm offering from a product standpoint. Now, it's easy to talk about product market fit if you're more consumer facing or let's say B2B businesses. It's a little bit of a difficult, a little bit of a different concept if we're talking about, if let's say biotech or space venture, right? So the so-called product is just the government, and it's very simple, or if it's a biotech, it just, if you pass the FDA, sure, if you can cure disease, that's no brainer. So that's very different on those, what we call very unique market spaces, but understanding typically what the startups I have to deal with are consumer-based or SaaS software or B2B businesses. So typically, how you estimate, how you try to understand, how long and how much you needed to get to your product market fit. I help company understand those 3 phases, right? The first phase is let's say you have a concept you can draw on a napkin, but other than that, you have nothing else. So when you have that an idea, you probably need a one product person, and the product person tells you how your product going to look like, what your product is doing. And it could be yourself, CEO and founder typically is a product person or a technology person. You need a little bit of a depth, the team, just to put things into more organized fashion, like a demo or like screenshots, a wireframe, and all that stuff, or build a website and build what we call a wait list, for example. You do need a small budget to do user surveys and feedbacks. Okay, so this is an iteration of a process of trial and error. That's why, especially in the early stage one, take about 2 to 3 months to figure out, okay, who are my target audiences? Is it everybody, or is this like a specific segment? Is it defined by gender, race, or by certain shopping behaviors, income levels? So it is your product, and you have to kind of work your way into understanding who are your potential target customers is, right? Let alone offering something in terms of features or functionalities or capabilities. So once you understand, okay, I need a one product person, I need half dev, I need a budget. And this is typically talking to either your other mentors or your product persons and understanding, okay, and also depending on how effective you work your what we call the customer segments. It might take a brand new startups for 2 to 3 months to come up with a very good idea of who I want to target to. It might take a little bit longer if you're kind of running into a lot of issues, but it might take smaller if you're a serial entrepreneur. You're very savvy as far as finding your product market fit. So from that standpoint, you understand what you need to do, and then you kind of bake in how much it's going to cost, right, in terms of time. And you start to formulating a foundation for your basis of what we call the finance needs. Then as you go through the second stage, again, the second stage, let's say you validate the concept, your customer, you think your customer is going to like your products, but you haven't had anything yet. Now you start to build into what we call viable product, either let it be a cell phone, the version 1 that people can test it, not to the scale that that can host let's say tens or 100,000 users at a time, but you start to developing, and you start to get feedback from the customer in terms, yeah, I like this feature. No, I didn't like this feature. And it takes too long. It takes 4 clicks to get to that point. I'm losing my interest. You start losing customers in those kind of ways. So a lot of, again, different type of customer feedback, different kind of service that now you're doing, more focusing on the actual product that you start to develop, right? So within 1 to 2 months, again, the 1 to 2 months is just a general framework. Try to work yourself to death as far as understanding how long I need to work on smaller features one at a time, so that when you get to a point, let's say 2 months later, you say, okay, I basically understand from my customers' demand that I need this kind of product in order to getting my foot in the ground and getting everything launched, right? So by then you already might have being 4 or 5 months, even to a year pass by, that you might have kind of put the money yourself or from families and from friends, and those are the money that you actually need to keep track of it in terms of understanding how quickly you run through your company's initial budget and how fast you burn your companies, assuming you haven't get any funding, right? Of course, you can add early stage phase 1, you can already start going out to ask for funding. Typically, serial entrepreneurs have a much easier time get funding when they have just a basic ideas. They have track records, have credentials, compared to founders who fresh, never had any venture-backed experience in the past. They tend to try to prove themselves, and that's exactly how you go through the different steps to prove yourself. That telling the founder, telling the VCs, hey, this is how I prove myself, why this is a viable product or business. Again, phase 3 is just another iteration based on what you have done in phase 1 and 2. Now you need more people. Now you need marketing. You need to do a little bit of PR now. You want people to know it. And you will see in the phase 3, I added growth person. So growth is a misunderstood concept, meaning that what is growth? Is growth meaning that now I have a product, I need to grow my customer base, or is that growing my product profiles? So it's a balance act, as you will see in the later stage. Product and growth typically goes hand in hand, but product should technically drive the growth instead of growth driving the product at the early stage. You don't want to grow too big, right? You don't want to, kind of get all, excited and spend a lot of money on advertising, and customer come to your platform and they say, oh, your product's not ready. So you technically wasted all of those money. So it's all about being able to gauge and balance based on your own team's speed, based on your product kind of focus in terms of where your customers are and how you play the game as far as getting the customer interested, engaged, and offering them something that's more valuable in return, and continue to build upon your existing success. So overall, by the time, at the end of phase 3, I think typically this is a very, very good time to either tell yourself, okay, I don't think I have a product that my customer would ever want. Or you can say, yeah, they want it, but the demand is not huge to, let's say, gather a potential 10,000, 50,000, or 100,000 users within a year. Those are the type of growth trajectories that a VC potential will be looking for, and will kind of give you the term sheet without even sometimes you asking. Or it could be, at end of phase 3, everything demonstrated really, really well, very good track records. You feel like this is the right time. I need to go out to talk to the VCs and see and show them the traction that you have gotten it. And based on this, you can actually calculate your potential valuations and asking the VC to help you fund the next stage of the development. So that's kind of the initial introduction for the financial product market fit, right? And I talked about a little bit about growth, and I talked about which one goes first. Is it growth first, or is it product first? Why is this so important? I've come across many instances where company get a lot of the fundings. They already budgeted. Let's say I'm going to do $100,000 each month on advertising. Sure, the budget itself makes sense, but does it make sense to put $100,000 into advertising or growth if your product hasn't reached a stage where it is widely accepted by your customers? So how can you measure if your product is widely accepted by the customers? And that's what we call the retention, right? So the retention is where you actually value, depending on industry, each retention metrics is very different. There's a lot of the different ways you can measure retention, as kind of pointed out in the below, the key to product market fit in terms of retention metrics. What is your DAU, daily active users, versus your monthly active users, right? That tells you how many customers are coming back. Hopefully those so-called coming back should be organic, right? Without you even prompting them, they have started forming a habit of coming to your product or platform to understand what will your product can offer on a continued basis. And a very, very good retention metrics measurement is how many repeating customers paying you, right? A lot of the time it's the content businesses that give people free information or freemium information. Those are good as well, but nothing can beat a product that asks your customer to pay you and they come back on a consistent basis. So this is the MRR, the monthly recurring revenue or annual recurring revenue, depending on if you're charging monthly, quarterly, or annually. And of course, some other businesses like our cheese businesses, the debit card, we look at total transaction in terms of volume, like how many transactions that were being done on a monthly basis, but also how money they spent. Is it on 1 million this week or 2 million next week? So if you can compare yourself with those 3 types of metrics to an industry average in your kind of a vertical or segment, you can actually get a very good sense of, okay, I got my retention up. I continue to do my retention. Should I spend money on growth so that I can continue to grow my retention? Or the more money you spent, it's just a matter of attracting a lot of customers, but the retention is not going anywhere, right? So those are the analyses. When I say financial product market fit, you have to take that into consideration. Once you have those kind of what we call track records, you have to put into measurements. You either need to improve it or you need to pivot or do something better at it. Otherwise, if you just say, I'm gonna spend $200,000 every month on marketing, sure, you're gonna grow probably a lot of the users come to your platform. We talk about cost acquisition, doing the ads, but as soon as they come and they leave without retention, it's very, very difficult to say how are you going to grow your company in the next cycle in terms of meeting the product market fit, okay? I want to kind of shift slightly in terms of financing your product market fit. In terms of, instead of let's say, okay, let's assume we understand the product market fit concept, the growth, the retentions, the metrics. There's other ways you can actually save a lot of the money to finance your product market fit, right? So at the end of the day, the reason I focused on this so much, early stage company, it's do or die product market fit. People want to use your product or not. They're willing to pay for it or not, right? And the less you ask for the VC for money, the more you retain the value to your own companies. So one of the key area as a service that I offer, also a startup myself, is the R&D tax credits. So to many people who, if you have heard of it, I think to this point, if you're in the startup space, R&D credit is no longer a foreign term anymore, right? Not unlike 2018, 2019. So the R&D tax credit essentially saying that if you had spent either on hiring your own people, when I say hiring your own people in the form of W-2, you pay them wages, okay? Or you pay your outside contractors, right? You have contractors building your products or platforms or softwares. Either way, the money that you paid out to them, as long as they happen in the United States, you can actually capture those expenditures and turn that into a credit that's available to you. All right. I'll give you an example. In 2021, let's say the 2021 that just concluded, and let's say you hired one engineer, one outside contractors. Typically, these engineers goes the rate about $100,000 to $150,000 a year, and outside contractors maybe a little bit more, a little bit less. But let's just hypothetically speaking, you had a 1.5, what we call full-time equivalent that's developing the software, and you spend, let's say, $100,000. Okay, so if that is what you spent in the 2021 of the $100,000, if they can be considered as qualified research and development expenditures, you're able to get back $10,000 or 10% from your spending. Okay, so once you have this $10,000, now prior to 2017, the IRS said, "Great, you have R&D credits. How can you use it?" They said, "Use that $10,000 to offset your corporate income taxes." Well, that's kind of a moot point because no startup will ever realize profit. Some doesn't even have revenues, right? So when do I ever get to use this $10,000? Never. That's why prior to 2017, startups never actually took advantage of the R&D tax credit because it wasn't applicable to them. Not that they don't qualify, okay? They actually qualified. But since 2017, the IRS said, wait a minute, we wanted to encourage innovations. We wanted to encourage people more going into those very unique industries and build great companies. So they're just saying, now you have $10,000 of credits. Instead of having to offset income taxes, I would allow you to offset your company's payroll taxes, regardless if you're profitable or if you're revenue at all. Okay. So for companies, once you decide that you're going to hire individuals in the future, or if you already have employees on your payrolls, you will need to pay 6.2% of their payroll to the IRS. That's a burden on your company you have to pay into it, right? 6.2%, up to $8,200. I think that was in 2021. So a company that has 10 employees, you need to pay $82,000 a year, just to the IRS. And you can easily get those money back to offset the payroll taxes. And that's why it suddenly becomes very, very popular. All right. So that's another way. R&D tax credit is a good way to, help you, reduce the burn and also increase your runways. And each company, if you qualify, you can have up to $250,000 for the next 5 years. So $250,000 times 5. That's actually almost in a Series A round, or sometimes a really good C round in terms of fundraising, that the non-dilutable and it's money coming back to you. Just to be careful, not everybody can do the R&D tax credit studies. It does need a little bit of what we call industry credentials. So I spent 11 years in EY doing R&D credits, and that's why I came out and do this software as a businesses for a lot of the startup businesses. And also want to talk about grants. And these days, in the past, grants were only available to companies that in the very what we call high tech, biotech. There's a lot of the bio companies, medical companies that they have all the NIH grants. But I also see these days that the grants were given out to local businesses. They just want you to be able to stay afloat, continue to help your employees. There's a lot of the businesses that I remember during the PPP time that LA City was giving out grants in the average of $10,000 to $50,000 for the applications. So continue to look out for those. There's a lot of foundation that also, for a purpose-driven grant. If you kind of help a specific, let's say, unique segment of the, female founders or underrepresented minority, there are also a lot of some of the grants that's available for those, regardless if it's a foundation. There's also a lot of the public funds that they try to, from a PR standpoint, it's good for their funds, but also they wanted to encourage those kind of spending and those kind of job increases. And of course, look for university helps. This is the thing that I actually discovered, especially at early stage, when I have an idea, when I want to demonstrate to someone else, hey, I have a mobile app, right? And I don't want to just to stay at the screenshots stage in terms of representing. I want to be able to demo it in front of the investors. The investor knows that before you have any monies, they're not going to ask you to, come up with a fully blown apps that can do everything. So what do? Every single university, okay, computer science department have a class called a capstone. So the capstone project, essentially the professor asks the students, she says, hey, go outside in a real business, find a project within 4 months or 5 months or a semester, you need to complete this capstone, okay, and help your stakeholder, essentially could be me or could be you, give them the requirements of what you wanted to develop. And they will actually develop a free software for you. Now, don't put too much expectations. Like I said, this is when you have some ideas, early stages, you want to get some help free, and it can validate your ideas, right? You know, what it's going to look like and how. I actually worked with USC. It's interesting, since 2018. Every single semester, I'll send them projects to work on it. Of course, you know, there's different in terms of the level of attention that students can give it to you, but also depends on how well you manage the teams as well. But I actually have had 3 products that came out of it that was very useful, very demonstrable, regardless of for my own purposes or for, you know, kind of continue developing out for demo purposes and for investors. I found it's very helpful. And it's as easy as look up on the internet, you know, go to Cal State Fullerton, Cal Pomoli's computer science website, email the department chair and say, hi, I wanted to ask if you have a capstone project. I would like to supply with a project that will be beneficial to your students. Students appreciate that because then they don't have to go out their own way to find projects. Professors appreciate that. You know, you're giving the students a lot of opportunities. The students will also get to work with you on the real life experiences, right? You know, in the real job, as far as, you know, being able to help a potential customer solve a unique challenges or questions. So those are a lot of help I have discovered that are very, very good. And of course, the last item is mentor networks. Here we have Preccelerator. We have a lot of mentors in different areas. Use all their time. I mean, just, you know, don't feel bad. You know, they're here for a reason. So use your time. You know, get connected to them and asking them how can you help. A lot of time I found that the mentors not only good at their own subject matters, they also have accumulated a lot of the network and resources on the other area of expertise. If they can advise you themselves, they actually have a better connections or better resource that they can introduce you to the different networks or the vendors, the friends that who can help you with that. You make your own decision who works with you or who syncs with you better. Incubator and Accelerator, of course, aside from giving you the money that you need, they also give you the platform to be able to grow your businesses. So overall, financial product market fit, I think it's a little underlooked. But if a founder has started to develop a good sense of how to manage your finances, especially if you can demonstrate that, you know, I can spend $500,000 to get a really good product market fit to ready to launch, compared to if I spend $2 million to spend it. It's a huge difference in the eyes of the investors, right? And so they know, hey, this team had the not only the ideas, but also they have the ways to be very lean and very product driven as far as, you know, making the product work. All right. All right. So financing your product. Are we doing good on time?
Yeah, we're fine on time.
Okay.
We've got
So
20 minutes.
okay, great. Once you, let's say you understand, okay, once you go through the iterations, you understand, okay, how much I need to spend. Typically, this is how my team works, how I get to a certain product or features were rolled out, and how many are on my books as far as how much I have to pay them. Then you start to develop this financial projections. Now, there's 3 things typically when I talk to early stage companies, focusing on what matters to the business the most. Of course, you know, we're talking about finance, right? How much you wanted to spend, but in the financial projections, you're also telling the stories. And a lot of time I have a financial projection sent to me. It's 3 years and the company barely started. So the first question I ask is, how do you know what you're going to do in year 2 if you haven't had either product, or you haven't really demonstrated if your product is going to be what we call market fit, right? Things could change dramatically. Even in mature businesses, we're talking about, you know, mature in terms, let's say they have been funded in the past, they still pivot within 18 months or so. So from doing a financial projection, the first guideline is, depending on where your team's at or where your product's at, try not to extend too much, because that, you know, in the eyes of the VC, especially you just put random numbers on it, it's actually wasting their time as well. Try to focus on the first 12 to 18 months. And also within the 12, 18 months, put a lot of the key revenue assumptions in it. And that's what the VCs are looking to see. Where are customers, right? How do you acquire them on different channels? Are you talking about if it's B2C customers, are you doing ads? Are you doing referrals? Are you doing campaigns? Are you doing word of mouth? There's a lot of those different channels, and each channel comes with a different what we call acquisition cost as well. So if you can lay those out, right? And by laying those out, I am assuming today that you actually validate it or at least try some of those what we call acquisition channels. And it just gives VC more confidence that, hey, you know what you're doing. You had experiences in terms of acquiring customers. You're at the ground zero. And of course, how fast do you acquire them, right? So I can take 2 years and acquire 1,000 customers versus if it could take 2 months acquire 1,000 customers. Those are what we call tricks or growth hackings. We're introducing a very unique concept. And also VCs likes to see revenue stream. The revenue stream in terms of more or less, that's up to your businesses. Sometimes I try to say less is more, right? Especially at the early stage. You don't want to say, yeah, I can make money. My product can make money in 10 different ways. I can sell businesses, I can sell individuals, I can sell online, everywhere. Okay, great. If your money can, if you have so much money coming from different streams, but the key question is, okay, well, how come other people are not doing it, right? So either something that math doesn't add up, or you're just kind of bluffing your way out of, trying to buffer your way out of the term sheets. So staying on what you're good at, typically the revenue stream. If you have one really solid revenue stream, build upon it, understanding where are customers, how fast you can acquire them, and demonstrate to VCs or yourself, hey, this is, I think, reasonably, I can grow this. And of course, with VCs' money and also their resources, they can help you grow. And of course, one of the very important things is understanding your cost acquisitions. You don't want to finance your customer just to bring them in without them giving you value in return, right? We no longer wanted to grow the business just because VC has a lot of money to give it to you. We wanted to make that you can actually generate blood yourself. And once you have those assumptions in, and it's typically in the revenue section or above the revenue sections, it's a lot of the key factors. Then we go into the second area, what we call marketing, R&D, or G&As. The difference I'm trying to make here is that you don't have to go into a very, very detailed level in terms of how much you pay for rent, how much you pay for water or food, transportations, lodgings, especially at early stage, even your revenue already, VC typically don't look at those in any of the detail or microscopes. Lump everything into G&A. If your company is R&D driven, meaning that your product or your revenue is heavily tied to R&D, that's a good indicator to show them how many R&D you want to continue to hire, because you're technology driven. There's a lot of value in the technologies to certain VCs who are technology backed, who tend to invest in technology backed companies. Of course, marketing, right? We're talking about marketing is how fast you can grow your customers. You're still iterating at a certain point, regardless of your peak revenue or early revenue stage, how much you're going to spend your marketing and where you're going to spend and how fast and how quickly you want to grow to a certain point. So those are the key criteria in coming up with a pretty solid financial projection in front of any venture backed organizations and ask them to take a serious look at it. I didn't put any of the what we call formulas, this add this to that. There's many ways. You can actually ask your CPA, ask any friends who has a good economic or accounting background to help you combine those together. If that's not your kind of forte to do financial projection, but just making sure those ideas or concepts are baked into it, so that when you present it, focus on the story, not just the numbers. All right. Okay. So here I want to kind of talk about for company might have revenues already, steady revenues, and typically we give them a title called a growth company, right? Still early stage, had a product that people are using. The retention might be 20%, and meaning that 20% of the people are driving 100% of the folks in terms of revenues that they are the company is getting. When a VC look at a growth company, typically hopefully it's at a Series A or even pre-A stage. The VC is ready to cut a check in anywhere between $5 to $10 million. And these days, we're talking about a pre-A or Series A stage. So working with a lot of the companies, including my own, this is the 4 areas that we're constantly being asked on it. CAC versus LTV. So the VC wants us to think that if I cut you a check for $10 million, you're not going to spend on acquiring all the customer without making sure that they give you the money they spend on your platform or incurring revenue in return. So that's the number one criteria you're going to look at it. And also gross margin, just to understand, okay, you're selling at a price, but making sure your variable cost is not greater than your margin. Otherwise, you're not building a good business, right? Unless you like Amazon, where they can use their Amazon software to support their Amazon merchandise businesses, but it's very difficult to build into the Amazon type of scales for everyone. So just making sure at the early stage, at least you can demonstrate you are on the right trajectory as far as gross margin for your product. Capital efficiency, I didn't even look at this in the past, but the capital efficiency essentially says how much cost you're incurring for each customer or for each dollar of revenue that's bringing from the customers. So think of this way mathematically, if the capital efficiency is equal to 1, that means for $1 of revenue that you generate from the customers, you're spending $1 to get that, right? So that's a ratio of 1. Is that good? Well, it depends, okay? If in your early stage, you're still trying to validate your product, it's not bad. Even below 1, that's okay, right? Because you're trying to still come to a product market fit. You're still trying to acquire customers. Your early stage, you haven't got a lot of traction. A lot of different what we call acquisition channel in terms of clients have not come in yet. So it's early stage, it's fine. But as soon as you get to a more of a kind of stable stage, okay, you have a lot of repeating customers, you wanted to make sure that your capital efficiency start to increase, meaning that for every $1 you spend, hopefully there's $3 coming in. Okay, the capital efficiency typically is used in a SaaS or B2B businesses, and the typical metric is 3 to 1, meaning that for every dollar I spent, I wanted to get $3 back. Okay. Because you got additional other $2, what we call the margins, to cover any other costs, right? So for a company to be profitable. One of the downside of using capital efficiency to measure your company is it doesn't bake in the growth. A lot of the time for growth companies, we can't guarantee the capital efficiency is either going to be more than 1. It could be a fraction of 1, but that's okay as long as you can demonstrate. I have a clear vision that I can drive my company and spending the capital that I get from VCs and have much greater return in the long run. And again, last thing I wanted to mention, I cannot stop mentioning it off and on, is the retention. What's your DAU? What's your MAUs? What's your recurring revenues? VC constantly asking us, show me those metrics. They wanted to understand, is your company at a stage where we can put money into kind of a supercharge of growth, or is the company still trying to figure out where you stand in terms of the market, who are you targeting, who your potential customer, or the customer base is large enough? So combining those 4 metrics together for a company that starts to have revenue, and think of those metrics that the VC is going to ask you, it will really help you kind of position yourself, right? And if all your metrics are not that good, if you want to get a term sheet, that most likely you're going to have to dilute a little bit more in order to get a sizable term sheet. But
before you go into valuation and dilution, one of the biggest questions I get, or most often, is how do I calculate my CAC LTV when I don't even have a product launched yet?
Right. So that's a good question. So it's typically what we look at is who you're competing against, right? So if you're competing with a product that's closely resembled to you, you can actually take their CAC. Okay. Typically, you can look at their. A lot of time, there's 2 ways we actually get those what we call information. Typically, they're not available on the internet. You can't search on Google, and nobody can tell you the CAC. Your investors, your networks, they normally get pitch deck from those companies, and on the pitch deck, typically, I hope the investor is just not going to throw you a pitch deck, right? But like investors between networks, from friends. For example, if we wanted to get Dave's, the Dave is a fintech program that we got just when it's SPAC. Our investor, might actually tell us if they have ever seen a certain number and say, hey, this is the CAC, and make sure you kind of work towards that kind of a metric in order to consider at the industry level, or at least you're kind of not too far off, right? The other way you can do it is, of course, estimate. look at it, do a little bit of a what we call soul searching or have feedbacks, asking the customer how much you're willing to pay for the services, and look at it how if you're using the let's say Facebook ads to get those customers to do the surveys, you kind of know in the future you can get those customers in the same channels and how much they're willing to pay, and you can use those metrics. But those metrics tend to fluctuate. They always tell you, yeah, I'm willing to pay, but when they really when you really ask them to pay it, they actually don't follow through. So you need to discount it. But again, CAC and LTV is fairly helpful when you already have revenue, you already have customers, and this is where I think if you can bootstrap it to the longest possible, right? You're kind of accumulating a lot of the assets, you're accumulating a lot of the expertise, all your customers, you have understand all of the acquisition channels, and you kind of test it out. And let's say you have all of those, and then you present it to VC. Look, I've done all those. Okay, so suddenly the VC will say, "Wow, this is a $10-20 million company. Let's work it together." Versus you have nothing. Your numbers aren't good. Then if you typically present it, and if you're lucky, if you get a term sheet, let alone a good valuation term sheets. So I think we covered quite a bit right today in terms of finances. I know I kind of go outside of the typical what we call the CPA's hats. We're looking at a lot of the metrics, a lot of the projections from a founder standpoint. So really want to take the next 10 to 15 minutes and see if anybody has questions, or I can help you, address your particular questions.
Yeah, hi. I have a question. Can you hear me?
Yeah, I can. Yes.
Yeah, well, thank you. A fascinating presentation.
Mm-hmm.
I have actually two questions. My first question has to do with developing a working prototype to present to an investor. Okay. How you talked about reaching out to a university computer science department.
Yes.
How do you protect your idea if they take it from the students leaking your concept out and maybe going online, and then suddenly,
right.
You find yourself like other people are copying what you originally, your concept.
Right. So Pablo, right? That's your name?
Yes.
Pablo?
Yes.
All right.
Yes.
So I'll give you two answers. The correct answer and also correct answers. Okay. So the correct answer is that whenever you work with a university, it's actually very common. You can actually make that known to the professor and the students to sign what they call a non-NDA, right?
Right.
Non-disclosure agreement. So the students understood, the professor understood. My experience is working with the students is that even your idea is highly innovative, highly IP driven, students tend not kind of get that kind of a sense at the early on stage. But that's not to say the risk is not there. But what I'm really trying to say, okay, let's assume NDA is in place to protect your IP, right? You can sue them, all that stuff. But NDA sometimes doesn't really do what the NDA is supposed to do. If you're leaked, you're leaked. Doesn't matter if you're an NDA or not. Mm-hmm. But on the opposite side of it is that if you're at an early stage, okay, and I deal with that quite a bit. And if you think that at an early stage, your idea is going to be leaked out and therefore you can't launch your businesses, and no offense, Pablo, I actually talked to a lot of VCs. VC will say, well, even if you launch it, people can still catch on to it and just reverse engineer what you have.
Right.
So it's almost like, oh yeah, what if Amazon comes and see what you're doing? And if they don't want to buy you, they think they can just do it in 2 months. How are you going to address that? It's the same question. So to me, it's not how early you launch something, it's how well you operate it in the future, right? So when you design and develop a product, especially a technology, let's say a mobile application has a lot of functional capabilities and the features like that, it still takes a little bit of a work, okay? When I say work, dev work, product work, right, and marketing work in order to go to a full scale and saying, yeah, I need to protect this and put that into a kind of a, asking an IP lawyer to help me protect this. At the early stage, it's great that you have that kind of concept, you wanted to protect yourself, but I would think that, think of how you can grow it before protecting.
Right. No, I agree. I'm actually coming to that conclusion. It's better to test it out, put it out there, get some feedback, And once you start getting some real interest, then you think about the legal aspect.
Yes.
So thank you. I have another question that has to do with calculating the cap.
Okay.
So you told us to really, we need to know who we're competing against and see what their cap is. So when when we in the case of a company that doesn't have a history of selling product like mine, for instance, so when you don't have relationships with investors, how can you approach them? How do you first of all, how do you find out what type of investor invests in the type of product that you are developing? That's the first part. And once you find out, how do you ask them?
Right. Well, the first. Go ahead, Pablo.
So how do you find out the right type of investor, and then how do you approach them with a question? Hey, I'm really interested in getting an understanding of what is the cap for this type of product. And I noticed that you invest in similar products. How do you ask that when you don't have a relationship with the investor?
Well, I tell you, this is a very easy question. You see the gentleman that sits right there? His name is Len. Okay.
Yes.
Right. So this is, I think, Len's job is connecting you to different advisors, different investors. Right now, Pablo, maybe Len might sometime pick and choose. I would, right? I don't introduce every single company to my circle of investor network. I do my first filters first, but there's also a lot of networks in a Preccelerator that you can kind of, pick based on their special expertise, either be their industries, experiences. Like I said, it doesn't have to be a product. It could be legal attorneys as well. It could be marketing as well, especially marketing. That's very, very strategic, right? Once, let's say, you find a mentor or find a VC that they're willing to take you for a 15 minutes meeting. If, let's say, this VC invests in your vertical, the segments, I can tell you they have done over at least 100 to 200 companies that serve similar, if not the same industries of yours, and they can easily tell you they would like to see a CAC in this in order to write a check to you. It's a very straightforward question to the VC. If they don't know it, forget about them. Probably not in your lane.
Yeah. No, great. Thank you.
Yes. Yeah. Any other questions?
Anyone else have questions? I guess not. I asked all mine during the session. So.
Yeah. All right.
Let me come on.
Yeah. Well, it was great. I know we're still getting back to the COVID, getting used to it. I myself was the first time coming back since 2019, but we'd love to, come out more and, see the bigger audiences next time. Yeah.
Sure. And don't forget, we did provide lunch today, so you missed a beautiful lunch. So please, if you get to Santa Monica for our next workshop, we'd love to have you here. And with that, Zen, thank you so much for being part of this today.
Thank you.
All right. Thank you, everybody.
Thank you.